Good morning, everybody. My name is Bernie Horn, and I'm a Sloan class of 1980. And I'm. It's always good to have a turnout from 1980 here. I'm very pleased to introduce our guest speaker, Professor Bob Merton. Professor Merton is the MIT Sloan School of Management Distinguished Professor of Finance and University Professor Emeritus at Harvard University, and the recipient of the Alfred Nobel Memorial Prize in Economic Sciences for a new method to determine the value of derivatives. Professor Merton's latest research focuses on finance theory, including life cycle and retirement finance, optimal portfolio selection, capital asset pricing, pricing of derivative securities, credit risk, loan guarantees, financial innovation and the dynamics of institutional change, and improving the methods of measuring and managing macro financial risk. Professor Merton has joined us today to discuss the crisis in modern-day retirement planning and examine how defined contribution retirement plans have become the main vehicles for private retirement savings. And just as an aside, as a class of 1980, in the class of 1980, we kind of witnessed the birth of modern finance. We were very lucky in many respects. In one way, we had no textbooks in finance. We just had handwritten notes, which were from working papers and theories that, there are many theories and working papers in the history of academia, and most of them don't see the light of day. So we were extraordinarily lucky that some of these working papers actually were material that won Nobel Prizes, which is truly amazing. But the rapid adoption, as Bob has commented in the past, the rapid adoption of the option pricing model had a lot to do with the fact that there was a huge need in the world on the back of the volatility of the 1970s in many different ways. The availability of a technical solution, which of course Bob, Myron, and Fisher had solved, and the infrastructure that enabled the deployment of that technology in a fairly rapid fashion. Bob's also well known for the time that he spends with his students, in many ways taking after his father, who was a professor at Columbia, and always had a huge attention to detail with his students, correcting their papers. His passion for students, brought him back to Sloan after retiring from mandatory age of 70 at Harvard, and he still has an active, a very, very active teaching schedule, not to mention his travel schedule on the subject of retirement planning. It's exhausting just listening to his travel schedule, never mind doing it. But I think this subject of retirement planning is one that's near and dear to my heart. I've been doing this really since I graduated from Sloan with a lot of people. And it's kind of interesting that when you reflect back on how the option pricing theory and contingent liabilities were so rapidly deployed, I think, here we are in 2015, where, we clearly have a huge societal need for retirement planning. We have the technical issues that Bob will talk about, and also the infrastructure is here to help rapidly deploy it. So if immortality and Nobel Prize and changing the world of finance isn't one accomplishment in your life, I know Bob's tremendously concerned that another one of his legacies is the issue of retirement planning. So please join me in welcoming Bob. Thanks very much.
Thank you. Well, thank you very much. It's a great pleasure to be here. Of course, with an introduction like that, if I were a truly rational man, capital R, capital M, I say thank you very much to sit down, because it can only go one way with expectations created by Bernie's remarks. But it's a Saturday morning, and you're here. So let me say a little bit about the topic area. You could think of this as an application of modern finance, of looking and being in the solutions business. I prefer not to call it retirement crisis. We use the term crisis. For me, crisis means we don't know what to do. That's what makes it scary. It's outside the box. We don't know why something's happening. I'm going to try to convince you that retirement funding is a huge global challenge versus crisis. And I call it a challenge because I believe we know how to address it. We do have solution. So it's an engineering problem, not a science problem. Cold fusion, we don't know. Now, when I say that, that doesn't mean it's easy to implement, or not a big deal, okay? But that's the frame that I would put it. I noticed as I was sitting here, it said post-retirement payout. And I realized if I took that literally, that's not what we mean. I think we want to say post-accumulation, or just take the post out of it and say retirement payout, but I don't want you to dwell on that. Anyway, one other thing I can't resist, I see a gentleman and a lovely lady about middle up center, and this morning they were crossing the street and I was blocking the crosswalk. I tried to move a little bit for you so you didn't have to walk there. So my apologies. Okay, sorry for the personal time. All right, so let's get started. And what I thought I'd do is first identify what the challenge is briefly, because it's always important to know why it's a problem. And what is a problem. And there's a list here. I'm not going to go through each one of them. But as we all know, the demographics in the United States, but elsewhere in the world are such. The population is just getting older. So we know the baby boomers here are now going to be, I guess we've started retiring, they'd have, and they've got probably another 18 years of, I don't know how many, 10,000 a day or something. I mean, some huge number. But as much as we're aging in the U.S., China's aging even more. Korea is aging more than China, and so on and so forth. So the demographics is clearly one of the issues that puts a strain on the retirement system. The second one is actually really good news. Around the world, people are living longer, partly due to nutrition, but a variety of things, all right? They are living longer. I think that's good news. Okay, sometimes when you have people talk about retirement, they say, oh, gee, people are living longer. Darn, bring back smoking or something, you know? And so it's important when we look at this problem that we remember this is a good thing, okay? But like many good things, it has dysfunctional or things that we have to do in order to adapt to the good thing. In this case, living longer. The few other ones I won't go into, one is the shift. This is much more important for countries, particularly in Asia. When you shift from one kind of economy to another, from agrarian economy to industrial economy, the old ways of providing retirement, such as the family and so forth, don't work anymore. And so that's another factor that's been going on. This is an issue in the United States, but not here alone. There is a huge legacy out there of unfunded retirement liabilities. That is to say, people have earned retirement from the past work, and we, whoever we are, owe them, and we don't have the funds for it. So it's underfunded. And that is a big issue in implementation and issues. And what we do know is that the big shock, first of all, retirement funding comes from basically three sources: government, like our Social Security, employer plans, and personal saving, the family. That's it, okay? And if you look at, take the United States, does anybody think that we're likely to have Social Security benefits go up? Okay, so what do we know about employer benefits? They've actually gone down. I can say that without doing a survey. Why? Because the big shock to employer systems, in the US, corporate systems particularly, but it's going to happen in the public sector as well, the big shock, starting about 10 years ago, was the shift from funding retirement employer plans through defined benefit plans to something else called defined contribution by default. But defined benefit plans, employers came to realize, were, for the benefits, they were far more expensive than they had estimated systematically and induced huge risks. And there's been an exodus in the corporate arena. It's basically the only major firm I can think of that has reaffirmed that that's what it wants to continue is ExxonMobil. But other than that, I don't know of any other firms. Certainly no new plans. So that's the big shock, and that's happened to the system, and that's where we're going. Now, if we're in a situation where under current practice it's not sustainable or it looks like we don't have enough, then how can we improve the resources that we have for retirement? And this applies for each one of you as individuals, because on average, each of us has to pay for our own retirement. I mean, he could give me some money maybe, and maybe I give some money to, well, you probably don't need it, but you know what I mean, okay? Happily, everyone in this room, I believe, relative to the world population, is in good shape for this. But I should say my remarks today are focused on solving a challenge for working and middle-class people. Poor people, we have a different set of ways of addressing that part of the life cycle. And those who are more affluent, a lot of the technology here can be used, but the thing is to design how do we deal with the hundreds of millions of people who are at what we would call working middle class. So let me just identify who we're talking about here. So it's, for most, it's not you. Okay, so don't use introspection, please. All right. So what we, you know, if you say, what is it that can we do to improve the chances of achieving a good retirement? There are really only 3 ways plus one more, so I guess you could call a 4th way. You either save more, work longer, or take more risk. If you've got a 4th one, please see me after the talk. I'll put your names up in lights around the world as the 4th way. But I know of no other. Oh, well, luck, but I don't know how to do that. It's always good to be lucky, okay? There is a 4th one, which is you can take the resources and assets you already have and make them more efficient. What I do not believe can be a linchpin in any way as a strategy for solving the problem is getting higher rates of return or expected returns for the same risk. You know, you can always solve these long horizon problems by saying, if I just earn an extra 2% a year, we're golden. Where do you get that 2% from? Think about it. I know some of you at least are in the financial service business, asset management and so forth. I think you all every day spend all of your time and energy and your employees' time trying to find ways to get higher expected returns for the same risk. So you're already doing that. So it's not realistic to say, oh, we'll just add a couple of 100 basis points. Like, hey, we had these couple of 100 basis points lying around. We didn't need them. Now we're going to use them. That isn't the world. And I talk about taking more risk. I just want to leave this here because in this particular area, it's notorious for coming up with wonderful theories that say, in the long run, risky assets aren't risky. Therefore, we can take the expected return on the asset and treat it like it's a sure thing. Because, of course, you can, as you all know, you did go to Sloan, if you can get higher expected returns if you're willing to take more risk. If you now say, well, we take the more risk, but it really isn't risky, you've just created a risk-free asset with 200 basis points higher return. And that's wonderful, but it isn't the real world. And for policy, those of you who are either involved in policy or who are influencing policy, anytime you hear them say, we're going to solve this by putting more in equities or something else, timber, I don't care what the flavor of the month is, say, okay, that's more risk. That's an acceptable policy, provided what? That the policy includes what do you do if the risk is realized? The wonderful trick of saying in the long run it's not risky is you don't have to answer that question. Because you basically say, in the long run, stocks aren't risky, therefore we'll get the higher return, and I don't have to explain to you what we'll do if things go bad. And I'm got you in a captive, at least for the moment, audience. I hope all of you remember that to the extent you have it. That's not a policy. That's a wish. And it's really important. So those are the 3 plus Stu, and I'm going to talk a little bit about that. As I mentioned, DC plans came in basically for reasons that the DB plans went out. And I thought I'd also give you a quick primer because, as you can imagine, retirement is something that's very tied up with politics. And I just want to show you it's like the second law of thermodynamics. There are some things that you can't do. There are no perpetual motion machines that I'm aware of. And if someone offers you one, to do it. So let me just take you through the simplest calculation, get away from all the nonsense, on what it means to live longer in terms of solving the problem. Think that, let's say, your parents or your older siblings, worked for 40 years, and on average when they retired had expected life of 10. So fundamentally, they worked 40 years, say 25 to 65, and they, on average, lived 10 years. So they had to fund 50 years of consumption out of 40 years of work. How much do they have to save? Well, let's say they were making 100 income. Consumption plus saving equals income, right? That's identity, all right? So how much would you have to save? Well, if I have to pay for 50 years with 40 years work, 20%. Therefore, how much can I consume? I have to save 20, consume 80. So you have a standard of living of 80. Pretty simple, right? Now, you discover, wow, you get an extra 10 years. Isn't that nice? Okay, what if you want to work the same amount that your parents or older siblings did? 40 years. Now what do you have to fund? 60 years of consumption because you got an extra 10 years. Well, the math is equally simple. How do you fund 60 with 40 years of work? You have to save 33%. But consumption plus saving equals income. So what does that say about your consumption? It has to go down. Now, I know this, you say, you're telling me this on a Saturday morning, we could have. But the reason I'm telling you in such simple terms, you notice I didn't put any investment returns or anything in it, okay, is because that's the fundamental thing. So when you hear people saying, we don't want to work longer, you know, you have these discussions of increasing how long you have to work, but we don't want to cut our consumption. That's one too many, okay? So you could choose to lower your standard of living, and it's not so bad, right? Because you get 20 years of retirement, you live 20 extra 10 years, that's better. Your parents only had 10, okay? So that may be what you choose. What if you say to yourself, no, I want to live the same way my parents did? Well, you can solve that problem too. Your parents saved 20, right? They consumed 80, so you saved 20. If you're living 60 years, how much can you, and you work, how many years can you pay for saving 20? 20% of 60 is 12. So you get 12 years retirement, better than your parents, but what about work? 12 from 60 is 48, you got to work an extra 8 years. Those are the two posts. Keep the consumption the same, but work longer, or work the same and reduce your consumption. And any combination in between is feasible. What is not feasible is both the same consumption and the same work life. And that, I just remind you, because you'll see so many times the arguments, somehow by magic, they're going to create that for you. All right, enough on, did I push the button? Oh, yeah, push, there it is. You could have told me. All right, let's move forward. Now, here's the thing. We're going to look at what we do in the world of a DC type structure. DC, I remind you, is where you contribute, it's like a 401k. You contribute, they're contributing certain amounts, and what you have at retirement is whatever the investment experience is with that money. And what that does is shift from the retiree or from the members of the plan, from a DB plan where you did nothing, everything was taken care of because the benefit was defined and was even structured so you could have a decent retirement if you worked for the company. Now you have the responsibility for deciding what to do with the money, figuring out one of the most complex intertemporal optimization problems over 30 or 40 years. How do you invest money coming in from contributions, do something with it so that what comes out in 40 years or 30 years from now is a standard of living? Yes, I know. I don't use slides. I put them up here so you don't think I'm non-voting. You could see that. So let me just, say, so the shock to the system is people haven't in the past had to make these decisions. These are probably the second most important decisions for working people after their medical. This is not a joke. That's why I wanted to remind you, this is working middle class. They're not poor, they're fine, but they don't have a lot extra. So if you screw up their core retirement, that's not giving up on a second car or a second house or anything like that. That's a real problem, okay? So this is a very important set of decisions, and they're being asked to make them. They've never done them in the past, don't know how to do it, and they won't know how to do it in the future, even with education, any more than people do their own surgery, okay? This is a very complicated problem to solve. So the question is, can we use a DDC structure and come up with a new design that works, that addresses the problem in a realistic way. And that's what I'm going to take you through. Now, as you all know, in engineering, this is MIT, of course, the usual approach is you say, first of all, what is the objective of the project? Objective here is a good retirement. I'm going to say a good retirement, my definition. Remember, there's going to be millions and millions of people who I won't know. So I have to tell them. Now, you're a young group. I can see it here. So probably, as sophisticated as you are, if I asked you, what do you want for retirement? And you say, well, I like a good retirement. I'd ask you, what is a good retirement? Tell me what the objective is. You might have difficulty telling me. And that's good, because you should be working on building your careers. You're not thinking about retiring, most of you, at the moment. So you know it's important, but it's not something you've thought about. So people like me are supposed to think about that. So I'm going to look at it as saying, not that I'm being paternalistic, I'm just going to answer the question that many people ask me. What should I want to have? You know, what am I going to want when I get there? A good retirement, by my definition, would be if you can sustain the standard of living for which you become accustomed in the latter part of your work life through retirement. We all like to live better, but this is kind of, for those of you who had a course with Franco Modiani, the life cycle, the hypothesis in which in work life and retirement we kind of want to balance. We don't want to live on dog food while we work, so we dine on crystal in retirement. And for most of you, it's an abstract concept. I will tell you that when you get to the age of retirement, you're not going to want to live on dog food in retirement if you've been living on crystal there. This idea is you just want to watch the grass grow when you get there. When you get there, you'll discover that's not the case. If you have your health and your brain, maybe one other thing, okay, you're not going to be all that different. So Modiani is the first one to formalize that, which he said basically we do that. It's important to remember, because as your circumstance change during the work life, that means your goals for retirement change with it, because you're always trying to balance. So if things go better for you, that's good news. What does that mean, though? We now have to probably save more to be able to accomplish a balanced retirement. When things don't go as well as we thought, that's bad news, but we also bring it down. We don't try to sustain it. Okay, so that's the kind of balancing act that we want to deal with. And so I'm going to take as the objective here for a good retirement is to sustain the standard of living. And how do we measure standard of living? If I came to your city, maybe you live here, but if I came to your city, you don't live here, and I looked and I said, this is a nice place. And he was here, and I don't know him, but say he was here. And I said, gee, he's living, I like the way he lives. He has a nice standard of living. If I said to you, what would it take for me to be able to live like him in your city? Would you answer to me be $2,336,540? No. You'd say you have to be earning about X. I'm just pointing out to you and reminding you, standard of living is not measured by an amount of wealth. It's measured by a stream of income, sustainable income. If you think of Jane Austen, and her mother in particular, when she was checking out all the men. Now look, this was 200 years ago in England, so I'm just reporting here. This is not an editorial. She'd say Mr. Darcy looked pretty good, but did she say he was worth 200,000 pounds? No, what did she say? He's worth 10,000 a year, a stream of income. Social Security is retirement. Do they tell us that we have a pot of money when we get there? No, they tell us what a benefit is. If you have a DB plan in your corporations, what does it say? When you retire, you'll get a stream of income for life. They don't say there's a pot of money there. So I just wanted you at the beginning of this discussion to realize that everywhere else that I've seen, except in the DC world, the objective is a stream of income, not a pot of money. Now, those of you who have been involved in DC know that the way it's typically done is everything is oriented towards a pot of money, the number, okay? And I just want to remind you that not only is that not normal, it is abnormal. It's the only place in retirement where that's the goal. And that's going to turn out to be quite important, and it's part of what I want to show you today, why it is important, and part of the change that absolutely has to happen in terms of regulation, in terms of design, in terms of all these things. So what I did as an engineer, as you would all do, is say, all right, we know what our objective is to get people a good retirement, design a system. What we always do, right, is to set up a set of design criteria. for the project. Before you do the detail, you say, this is what it has to do. If it doesn't do this, it isn't a solution. That's what this list is here. And this is the slide I'm going to spend most of my time on, okay? And this is my list. It says, first, the goal, the objective, should be a replacement amount of income goal. In other words, enough income in retirement to sustain your standard of living, okay? Typically, that's less than 100% of what you were earning. So if you were earning 100, to sustain it, maybe you'd need 85. What's the big difference? You're no longer saving for retirement. Remember that? Kids through school, that's it earlier. Yeah, they're about, well, but you got a lot of, we could get into details, but the one that we know for sure is you're no longer saving for retirement. And that's enough to bring it down below 100. But there's a number, and people estimate that number, but it's an income number. That should be the objective and the goal, not a certain amount of money. Then scalable and robust, low cost. We're designing this as a systems for millions of people. So it has to be scalable. You can't have an answer that works unless you can scale it. And it has to be low cost, and it has to be robust. You don't mess with that part of the life cycle for a whole country or whole region, let alone a whole company. So those are the clear. Risk, along with the objective, changes. We all know how risk gets typically measured in your investments, right? Standard deviation, volatility, something like that, right? You look at how much it bounces around in value. Turns out, for this purpose, that's the wrong measure. You're interested in your shortfall or your goal. First, you should have a goal. And so this is an example of goals-based investing. A lot of investing, by the way, as a side, is not goal. The way it's done doesn't have a goal. That's not a good idea, but it's the way the world is. But here, we have a goal, which is to achieve sufficient income. By the way, this isn't radical. Every one of you with a DB plan in your corporation, you have a goal. Your goal was to fund what you promised people. And that's a stream of income, right? And you look at your funded ratio, which is how much of that income could I buy today with what we've got versus how much have we promised to give? And that's the thing you looked at. So goals-based investing, particularly in retirement, is not a radical idea. But it does change very much how you invest versus people with open-ended, I always want more, 70-30, whatever else. And that's important because we have to do everything as effective as we can. So risk is going to be measured not by the volatility of wealth, but by the volatility of income. And when you understand, I don't mean dividends that you receive, I mean income in retirement for life. All right? Next. Oops. Number 4. I alluded to this earlier with you, which is it has to work well, not work, it has to work well if the members are totally unengaged. By that I mean they won't answer any questions, they won't go on the internet, they won't even answer the phone, they won't give you anything. They won't even give you their name, rank, and serial number, okay? And the design criterion that I prefer to use, remember robustness, is it should work well if the first time you have contact with a member is the day they retire. That's an extreme, and not likely to be an extreme that you'll actually have to do. But if you design it to work to that, then you know it's got to work okay. The key is you start assuming that, well, by the time they're 48, they'll do this. That's like saying, yes, and we're going to solve obesity in the United States. I've got a solution for you. Everybody will get up every day and do an hour and a half of calisthenics. It doesn't happen. And the engagement in retirement, people are not engaged in it. I gave you the reasons for it. Science has shown that. We have studies. I was a trustee of CREF for many years. Teachers, researchers, doctors, smart people, well-educated, and curious people. Guess what? Most of them, when they signed up, they asked, what's everybody else doing? And when they made an allocation, they almost never changed it. Okay, just like the rest of the population. So to have a system that has a linchpin that we're going to have people on the internet going back and forth and putting in their tastes and managing it and telling us all the good things that we need to know in order to do a job for them is not realistic. In fact, in the United States and many other places now, they have what's called the default, which is precisely a pension system which was should induce more people to enter retirement by having what they call opt-out versus opt-in. Opt-out means when you sign up as an employee, you're automatically made a member of the DC plan, unless you choose to leave, not to join. They used to do it the other way. You had to do it to join. And guess what? The one constant of behavior is people don't do anything they don't have to do. So when people are signing up, they have to check the box or sign up. Whatever they have to sign up for, they don't do it. So if you put them in the plan, but you give them the right to get out, so you're giving them free choice, they go into the plan. It's amazing. It goes like from 30% to 80. I mean, it's just huge, okay? They do this also for organ transplants and things like that. Opt-out versus opt-in, okay? It's a behavioral phenomenon. That's the good news. But if you have opt-out, that means you're going to have people going into the plan who hasn't told you what they want to do with your money because they've had no contact with them. And you do everything you do, and they won't come to you, okay? So out of that, you have to have what's called a default. What do you do with the money when they're not? Now, that turns out to be very, very important because it's not just for the people, a handful maybe or more, who won't respond at all. Most people, when they join plans, even if they say, hey, it's like voting, I want to vote, I want to make an active decision, but I have no freaking clue what I should opt for. So what do? They look at their employer, what their employer is doing for people who are the default. Because they say, I trust my employer more than I trust the banks, insurance companies, or brokers. That happens to be, I think, a reasonably well-established piece of empirical data. People they complain about their employers, but they actually trust them. So they say, well, what did my employer pick for people who didn't make a choice? And that's why the default is so important. It's not just the defaulters. It's all the people who choose but don't know what they want. And so this is a big responsibility. And it's very much like a DB in the sense you're making decisions for them, all the decisions. Okay? And that's where I'm going to focus most of my attention when we can talk about it. Then we have that any design today should have the feature that it's customized to the individual based on not just age, which is the way it's sort of done today. The best, I don't want to call it state of the art. The most popular form of doing this is everybody the same age is treated the same, okay? And I will tell you that that isn't good enough, okay? I hope you're not surprised. Because if you're in the asset management business and I can solve a complex 40-year intertemporal optimization problem under uncertainty, which is what retirement is, and I can come up with as simple an answer as, I know your age, all I have to do is know that, and I can solve your problem, then we don't really need a multi-trillion-dollar industry. We don't need all the valuable, highly paid people doing this if it's that simple. I'm just trying to say, I don't know how anyone could really believe that would be good enough, but that's what we do. We need to use a lot more information, okay, and it has to be customized. You say, well, on average, it's all right. Well, let me tell you about average. Sometimes average is okay. Let me take a look. I can see. And okay. There are some people in this audience, I would guess, who wear a size 6 shoe. And there are some people in this audience who wear a size 12 shoe. How would you like it if all shoes were size 9? Okay? Or I have my head in the refrigerator and my feet in the oven. On average, my temperature's not bad. I'm trying to give you, obviously being a little light about it, that average is generally not good enough, but sometimes you think, well, we have no other choice. I tell you, as a matter of technology, finance technology, computer technology, and real-world implementation, it is possible today to run these plans for millions of people with basically customized to their information. Now, it's not precise every little detail, but enough of that information. Now, remember, they're not engaged. That's the design criteria. So we have to get all the information without asking them. That's a bit of a hurdle, but it's doable, I will tell you that. So customization, if they don't offer that, you should be not accepting of that. Now, last is you must integrate all the sources of retirement. Now, you can't know all of them, but you do as best you can. This is not a financial planner for people. This is just solving one problem, getting them a good retirement. So you want to look at the assets that you know are dedicated to retirement, and you take account of them. And I'll tell you what they are. Social Security, or if you have it. If you happen to have a DB plan, even one that's capped, some people in their 40s and 50s have a fairly substantial accumulation. That's an important retirement asset to know about, okay? The DC plan, what else is very important? Well, your future contributions. And those should be thought of as an asset. Everybody, when they simulate these things, they just have an exogenous money coming in every month and they run Monte Carlos. That's fine for some things. It doesn't work well enough. You want to create an asset, because it is an asset, right? Future contributions are a stream of income. You're all in business and done this. Why do I make it an asset? Because we're not just interested in the value, we're interested in the risk. When we do portfolio analysis, you've got to take account of the risks of the assets. One of the biggest assets, certainly for younger people, is their future contributions. That's the biggest asset. And in order to do the right portfolio allocation, you all know that from portfolio 001, you've got to look at all the assets. You can't optimize a subset of assets and generally get to an optimum for the whole. So this is critical, and yet it's frequently not done. They often act like the DC plan is the island unto itself, the only source. The seventh one is if you get people engaged, and that's been the mantra if you're out there, get people engaged. I modify, I say get them engaged provided that engagement improves their chances of getting to a good retirement. You know, I might convince you to come home after work every day and get into your IRA or some other place that would allow you to do this and trade currencies in the evening. And it's like video games, you know, it could be very engaging, but I will make a very big bet that that will not improve your chance for success in retirement. So engagement should be only for the purposes of making things better for them, and defined as more success. To do that, we have to give only meaningful information and meaningful choices. And meaningful is different from important. Now, what do I mean by that? Well, you've all been engaged one way or another in buying a car, right? I mean, either you know somebody who did or you actually did it yourself, right? So you're a car dealer. I'm a car dealer. He's buying a car. He's just been to see you, and now he's come to see me. And he says to me, I've been to see him. I said, oh, he's a great guy, really great guy. But I got to tell you, all his cars, all his engines have 9-to-1 compression ratios. All of my engines have 9.3-to-1 compression ratios. Now, he's smart enough to know I'm trying to sell him the car. That must be better, right? Let me ask you or anybody else, how much more gas mileage would you get from a 3/10 higher compression ratio? How much faster speeds 0 to 60 will you get? How much more reliable will the engine be? Okay. Well, I, at one stage of my life, thought I was going to be an auto engineer, and I used to build and race cars when I was a teenager and worked for Ford in advanced vehicle design for a while as an engineering school. There is an answer to that question. It's not an easy answer, so don't feel badly if you can't answer it, because you'd need more data than I gave you anyway, okay? But that's an example, and oh, I will tell you, compression ratio is very important to the performance of the engine. So compression ratio is an example of important information which is totally meaningless to you in buying your car. My view is in DC, much, or if not most of the information you are given, and often given by law, I mean by regulation, may be important, but it's mostly meaningless. So I asked you how much Thai real estate you want to have, or even what asset allocation. Everybody knows asset allocation is very important. Do you want 70-30, 65-35, 60-40? Important, very important decision, totally meaningless. How do you convert that into income for life, safety, all those sorts of things that people care about? Do you see what I'm saying? We send you people, by law, we have to send you all the past history in the mutual funds. I've got colleagues here, as you well know, having attended here. This is a place that if you get a big head quickly, you just walk around for a while and it gets very small again. There are people walking around here with 160 IQs or PQs or however you want to measure it, okay? And you give them something and say, here's the past history. They assume that you're giving it to them for a good reason. They should do something with it. What should they do? Well, they have great IQs, they're brilliant. I guess it means I should look at whoever had the highest returns over the last 5 or 10 years and put my money in it. Well, what other meaning would there be for it? Why are you giving it to me? Of course, there's a disclaimer at the bottom in small print. It says, past history is no indicator of the future, so don't rely on any of this. I say these to you, I'm spending the time on this with you because these are key things that we have to change around the world. And you're a part of that. Those of you who have companies, those of you who are in the business. This has got to be changed because this is great. It's frustrating. You give people stuff, they don't know what to do with it, okay? And therefore, they don't make any good decisions when they're engaged, or if they do, it's by luck. The only choices that are meaningful for people have nothing to do with returns. They're basically, if I don't like, here's my goal. How am I doing in terms of getting to the goal, however you measure that? If I don't like how I'm doing, it's like you have a C grade or something like that, however you want to measure it. What can I do to improve that? I already told you. Save more, work longer, take more risk. That's it. 3 things. And those are meaningful. If I save more, my bank account will be smaller next month. My paycheck will be smaller. Okay? So that's what we mean by meaningful. Last, we need to have recognize that retirement is a 2-act play. We have the accumulation period, which is all that people thought about in D.C. for a long time because everybody being the baby boomers, were all young, so nobody was retiring that was important with D.C. because they had DB, all right? Now, we're happy. The second act is you've accumulated. How do you take it out? How do you pay for your retirement? What to do it? And that, in design, should be seamless, or as seamless as possible. Easy and seamless. Because the opposite thing happens when people reach retirement or get near it. When they're young, you can't get them engaged at all in retirement. It's an abstract thing. When they're reaching retirement, it goes to overload. Suddenly, they have to make a lot of decisions, one-way decisions, like do I take an annuity, do I do this or that? And they have a deadline. And that can be overwhelming in the other way. So there must have been some time by continuity at age 51 and a half on a Tuesday night that it was just right in terms of the amount of stress or whatever you want to call it. So those are the design criteria. All right, now let me just say a summary. The big difference between this approach and that is today, and just look at your own accounts, look at what you get by requirement, if you have a 401k or the equivalent. They're always showing you the NAV. It goes up or goes down. How much did your portfolio go up or down in value? What they should be showing you is how much did your retirement income go up or down. Those who are engaged in DB plans, that's the funded ratio. How much of what I have as my goal could I buy with what I've got now? If that's 70%, it means I'm 70% of the way to funding my goal. It's that matters to you. If that goes up, that's good. If it goes down, that's bad. And if you have any doubt about it, if anybody knows the CFO, who usually is the most senior person in a corporation dealing with pensions, and the CFO has to go to the CEO and the board, which message does the CFO want to bring? We made 20% on our pension portfolio last year, but our funded ratio went down. Or we made 4% on our asset portfolio last year, and our funded ratio went up. I assure you, and it's the second one. Why? The first one says to the CEO and the board, remember the $100 million you were going to spend on expansion or R&D? You're going to spend it on funding the pension because the funding ratio is down. If the funding ratio went up, you see, remember the $100 million you were going to spend on the pension? I've just freed it up for you to put it into the business. The only way I'm telling you this is because you hear all kinds of garbage stuff out there. I don't want you to believe it because I'm telling you. I want your common sense to understand and say that this is the way we should be thinking of it. And so that's important. The volatility I mentioned, the account balance size, as I said, the funded ratio is what matters, not the account size. And then on the asset allocation strategies, age is only one of many statistics. A 34-year-old male, and I'm only using gender because there still is a difference in the amount you need in retirement because women still seem to live longer than men. But that's the only reason I put it in there. A 34-year-old man making $59,000 a year and a 34-year-old woman making $130,000 a year have the same age. They have very little else in common in terms of their retirement strategy or anything else. And so this is the state of the general things. What we need is something that not only uses other variables, but most importantly, dynamically adjusts the portfolio to new information. Information about what's happened in markets, interest rates up or down, accumulation up and down, and so forth, but also personal circumstances. If you get a raise, I mentioned this before, now you got to change your goal. Therefore, you have to change your strategy. This is all doable. So those are the key points on this. Now, I promised on the retirement income, I mentioned here, real world, oh, by the way, I do everything inflation-adjusted returns because we're about standard of living. And so whenever I talk about interest rates here, these are like U.S. Treasury tips, if you're familiar, inflation protected. So you can get protected against inflation. Those securities actually exist. And in the last 7 years in the U.S., the long maturity has varied between 0 and 3%. What that translates into is the following. When you reach retirement for a given pot of money that you have acquired, if it's at 3%, you would get one level of income. To get that same level of income, if the interest rate is at 0, you need 26% more. So it's as if you're at a deficit of saving. In fact, I'll tell you one story. Some people I work with, this is in London. There's a portfolio that we run for gilts, real gilts for hedging this risk. Came up to me, I was there, and said, wow, you would believe this? Our gilt, that's just like our treasuries. Our gilt portfolio made 35% last year. Well, that was obviously because rates came down, okay? And people around me said, oh, like we all do, gee, I wish I'd gotten into that, buying government bonds. I said, you know what? I'm going to use that, but I'm not going to use it to say, gee, opportunity lost. I'm going to use that to say that if you have a retiree, or soon-to-be retiree, say 61 years old or something, if they were not hedged in gilts, their retirement income fell by roughly 35% in 1 year. That's a disaster. I don't know how else to tell you. This is not a game. This is really big thing. The idea that if I have the right amount of money, interest rates will work out approximately is not empirically factual. There's huge risks. I used to have to spend a lot more time on this, but you've all lived through it. I mean, just think of someone who has $1 million, but they're not rich. They really need to live on what they have rather than save it for something to give away, right? What did they get in a very conservative, by most standards, of portfolio 8 or 9 years ago? What did they get on that portfolio? Treasuries, or they even put it in bank CD, fully guaranteed by the government. Okay, 4 accounts or something, so it's full guarantee. 4 or 5%? So that's $40,000 or $50,000 a year. How much can you get today? Well, you said 0. How about 10 basis points? I mean, if you can find it for me, okay? That's $1,000 a year. Now, I could say I put you in the gold standard protection all through the crisis and everything. I had you in this CD, absolutely protected. And your $1 million is still worth $1 million. Okay? But then you might say, but I used to get $40,000, $50,000 a year that I could kind of get by on. I can't live on $1,000 a year. And what answer do you have? None. You can't say, oh, rates are for sure going back up, because if you believe that, then you have to explain to me why in November of 2012, U.S. Treasury 30-year tips auctioned at 50 basis points. That's 0.5%. Who's in that market? Not taxi drivers, ribbon clerks, or professors. That's a very professional market. If it was obvious to professionals that rates for sure were going back up, who would put money out for 30 years at 50 basis points? It may be a good speculation, but that's different from saying it's going to happen. So you've just done the wrong thing because you measured safety by the value of the portfolio fluctuation. All right, I'm not going to beat this too much more. You know the slide. The higher the interest rates, the less you pay for the same income. This is another one. I'll skip them. They're all saying the same thing. High rates, you need less. Low rates, you need more. But the key thing is the magnitudes are big. That's what the treasuries actually did. This is the real world. So if someone says that can't happen, it just did. All right? Now, final one on this is, I mentioned that if you were 65, if it went from 3% to 0, you'd have a 26%. But what I want to point out is not just for someone who's retiring now. If someone is 60 and retiring in 5 years, they actually even hurt more. Because not only do they have to pay more for the same income, but during the 5 years that they're holding the bond, they're earning a lower interest rate. So you see it gets worse as you get further from retirement. So income is really, really important. One more quickly on this is, I ran a portfolio, this is the way it's done in the world if you're not familiar with it, that you would use to hedge, let's say, an annuity. If you're a well-run insurance company, you want to hedge the annuities using market rates, you can do dynamic trading in the long duration bonds and hedge it. We ran that portfolio from 2003 on, and we recorded the monthly value, just like you would see on your, on your screens if you looked up your account. That left picture is the picture of the return for a 45-year-old who's got a 20-year deferred before he goes out. Does that fluctuation look to you like a risk-free asset, which is what it is? It's as hot, as volatile as the stock market, all because of interest rate changes. So when you measure it in funded ratio or income units, it has no risk because it's full faith in treasuries with the income locked in. So measuring it in the right units, it has no risk. Measuring it in the way we have to do it by law, even by regulation today, it looks pretty risky. The flip of that is this one, which I just alluded to. Treasury bills, the gold standard, this is what it got over the period. It's what you expect. Low returns, low volatility, never lost money. Okay? This is what it looks like in terms of income. It's the riskiest thing on the planet. And I just explained to you why. Remember, we saw income go from 40 or 50,000 per million to 1,000. That's volatility. Okay? So if you don't measure things right, you can't possibly manage it right. This is things we have changed. I can report to you after 10 years of this, governments are moving that way. Actually, the industry is moving to talk about income. They're realizing something has to happen. But it's deadly slow. And by the way, the lesson in general for investing is have a goal and make sure you're measuring the goal in the right units. Don't just knee-jerk measure it in terms of wealth. This is some more on that. If you like risk-return frontiers, here's the way the risk-return frontier. Here's that bond portfolio. It looks pretty awful. Lots of risk, low return. Here's the stock market. Here's when you do it in the income units or the funded ratio. No risk in that because we have it. Stocks are still risky but high return. Treasury bills over this period had negative return and huge volatility. Terrible. So if you like risk-return frontiers, you see they're a little different. Oh, if you're worried, Bernie, I was looking over, if you spent, a whole bunch of money on systems for your portfolio management, and your systems do this, and now somebody's telling you should do that, don't worry. It's as simple as changing to a different currency. In other words, if you were managing money for a Japanese investor, U.S. money, you would report to yen, right? You wouldn't report it in dollars. All we're doing is converting from dollars on the left to income or funded ratio units. And it's just easy. So you don't have to replace you don't have to hire any more people either. If you don't know how to do that, I'm teasing you because you do. MIT will provide you with a formula to do it, okay? For free. Okay. Okay. This is just an example of a dial when people get engaged. This is their current income. This is when they're retiring. This is what they're contributing. This is their goal, okay? And then right now, if we were to ask how much income we could do with what they have, with all their assets, remember, this includes future contributions, it includes DB, it includes Social Security, integrated. We're at 67. We're trying to get to 8. You can see it. And then you can change your contribution rate. You can change when you work to. You notice there's no rates of return reported on this. It's irrelevant. It's like the compression ratio. You don't need to know any of that stuff. So it's really pretty simple. And the reason I say simple, because we're going to have to put in DC systems where people have to make decisions. When they're not engaged, that's easy. There's nothing simpler than this solution because the members do nothing. So if they're in the default, which isn't bad, they'll probably do quite a bit better than most people do on their own anyway, or with even some advisors, okay? But if they do become engaged, you see, it's pretty simple to use, and it's a tool for customizing. Okay, last was the 2-act play. When you get to retirement, we have a goal of income, right? That's income for life, protected for inflation. But when you get there, you'll know a lot more about yourself than anyone, certainly anyone designing the system. And depending on what you want, you may want to do something different with the money. What we would say is, if we got you to your 8,000, it means you have enough money that you could just get an annuity for life, protected for inflation, that pays 8,000. But that may not be what you want. It may be, for example, that we didn't get you to 8,000, we got you to 7,000, and you want to set a goal that 5 years from now you're going to try to get to 8. That may be something. It may be that you have a spouse or significant other who's part of your partner who is going to be working beyond you for 3 or 4 or 5 years, in which case you don't need as much for that time, so you change for that. So there may be a lot of different things, but we can span remember these are working middle class people, not with lots of sophisticated tax and other things. That the first thing is you say, how much do they have guaranteed income for life? Then you can say, how much do you want to put in something that looks like the same thing? It pays the same stream, but it's for a certain number of years, like your expected lifetime, say 20 years or whatever from when you retire. Okay, but it's safe, but it just pays it and then stops. So what's the advantage of that? It's cash you can take if you need it. It's liquidity, but you give up the longevity protection because an annuity will pay you even if you live to 120. Is the good books wish for all of us that you'll be covered. This doesn't. It runs out in 20 years. The third one is a risk bucket, but again, you have a goal. It isn't that you should just have risk because taking risk. Risk is a tool. If you don't need it, don't take it. If you got to where you want to be, if you got into Cambridge, Massachusetts today, then you're here. No need to take additional risk. If you made it to what you want, no reason to take this. Now you can change your goal, but that's the key element here. So the point of the matter is that you may have these goals that I described, and you may, because you can't get there without taking some risk, have a risk bucket. The last piece is if people keep their money, everybody, again, remember these are people that, once you retire, you can't go back, and there's no extra money. Everybody, no matter what their IQ, worries about outliving their assets. Okay? And so if I take this pot of money and I say, well, I'm not likely to live that long, you can buy longevity insurance, tail insurance, which you can buy at age 65. An annuity doesn't start paying until you're 85. Okay? And if you don't make it to 85, you get nothing. So it's pure insurance. But that's a nice thing to buy because then you have the money, you're covered to 85, you take care of yourself to 85. But should I have the great good fortune to live longer, I can buy it. And, as a percentage of your asset value, because you're giving 20 years longevity, et cetera, it's a relatively inexpensive insurance for what you get conditional on you being there. These 4, I believe, will span almost everything that people need in retirement in the working middle class. Anything more complicated, they need a financial advisor. It's to be realistic. So I just try to get across as I close up on this, and sorry if I seem too homey, I put more equations up. But I wanted you to walk away today understanding that we have a big retirement challenge, understanding that we have ways to solve it, that all of this exists. Lots of changes have to take place from the way it's done now, but they're all doable. And that we can address this problem. And by the way, this is global. I actually put this in around the world, because while lots of things are different, some places you're covered for this, some places don't have Social Security. You adjust that. That's all parameters in the system. It was designed to begin with to work across geopolitical borders. It's not an Anglo-Saxon solution. It's not a U.S.-oriented solution. It's a global solution. It came out of finance theory, which, as you know, doesn't have a nationality. And that's the other aspect of this. This is something that can be applied globally. and it works. It will. I thank you very much. If I have any questions for me, by the way, if I've kept you over, it's because we didn't get started till later, and you get an hour's break, and then you get a real treat with Andrew Lowe. It's going to be good. So thank you very much. If you have any questions. Okay. Is there a question? If there's not a question, don't. You know, when I was teaching you, I would always turn my back at the right time so you could walk out without feeling like any sense of, okay. But if there is a question, I'm happy to answer it. Yes, sir.
Very nice talk about the kind of psychology and technology of addressing this. Do you know anything about the empirical scope of where people are on the ladder of response to this? Like, you know, if the typical middle-class participant in the U.S. were to run themselves through this, are we seeing them 50% short of adequate retentions, and so they're going to have sociological crisis even with the technology?
Well, I mean, yes, you've seen all kinds of projections, but you see, it's very difficult to make that using data because we're going through a major transition, DB to DC. So all the past data and all the past behavior that's drawn from those data is in a world where most people had Social Security and a DB plan, and DC was supplemental. So what people did behaviorally with DC historically bears very little relation. You have to be. So I would say be very careful about just looking at the point of interest. There's no question that we need to have more saving if we want to retain the standard of living. And I didn't get into it, but the two other features that at least just walk away in your heads that can allow you to get more from assets, the same assets. So we're trying to, you know, sometimes you try to get more assets, but sometimes if you can do more efficiency. The most important two are the annuity, which I talked about, because that allows you to get much more income while you need it when you're living, in return for giving up the money when you don't need it, when you've gone to a better place that you don't need money, okay? The other has a terrible name. It's called a reverse mortgage. It has a spotty history, and I have to say it's basically a government program in the United States today, heckums, and I don't think it's anywhere as good as it could be. I like the name in Korea. It's called a home pension, which is more descriptive. I don't have the time to go into it, but I will say this. I believe that a new version of the reverse mortgage, properly done, and I could tell you how that could be done, with a new name, will be one of the cornerstones of funding working middle-class America and working middle-class Chile and working middle-class Hong Kong. Mainland China is even very interested. In fact, Asia has shown remarkable amount of interest in developing this and already has it. Why? Because it doesn't require people to change their saving behavior. In the United States, in Italy, Germany, all these places, working middle class, basically the only saving they do outside of retirement account is their house. They don't have stocks and bonds and properties. They have a house. A reverse mortgage allows you to strip the value of the house that you don't need, mainly the value of the house after you don't live in it. The house is a perfect hedge for retirement. It's the right thing to own. But it'll be there after you don't need it. That value, if you can find it and move it back in time to enhance your living, very much like an annuity does, but it's different. That's an example of taking an asset that people already have, okay, and making it more productive for solving the problem. And what's pretty about it is a practical matter. It doesn't require us to change the saving behavior of 100 million, hundreds of millions of people. It works on the same saving behavior. So those are the things. So yes, we do have a big challenge, but don't start going to a tailspin that we are at the end of the world, that all this can't be solved, okay? We're not going to drive into a wall that's going to flatten us, okay? But we do need to address it. That's why I say it's an engineering problem. It's not, oh my God. Yes, sir.
One of the challenges we have is that investors, when they do get engaged, often get a much lower return than the market gives it because, you know, that behavioral tendency to buy high, sell low. So my question with these recommendations is how much do you foresee them as a mandate in a DC plan, and how do you take the control? I mean, once you take control out of their hands, you know, and say you had to buy this tail risk.
You're making it sound like taking control out of their hand. They don't know what they want. They're dying for you to do it. For them, personal finance, for most people, personal finance is like going to the dentist without Novocaine. You know, this is not something, hey, you've taken away my right. I will believe that when you talk about that, you're talking about people who are upper middle class to affluent, who are all that sort of thing, and a handful of people who, there's some people who like to build their own cars, knit their own. Most people don't want to do this. So if you have this idea, this is paternalism, taking away something they want, believe me, they don't want it. They're looking desperately. How many people, how much choice do you see in a DB plan?
Too much.
In a DB plan?
DB plan,
None.
None.
How many people can tell me of any corporate employee, corporate employees or public sector employees who have marched on their employer and said, get rid of the DB plan, give me the DC plan so I can make choices? This is the real world. You were talking about data. This is really important. So I'm sorry, that's a nice story, and it applies to a certain group of people, but not these, I think. I think they welcome it. And if you look, the biggest growing and fastest growing and most important area where people are focusing in DC is on the default. And for the reason I told you, not because they have defaulted plans, because most people don't know what they want, and they welcome saying, this is intelligently doing something for me, much like they do with their own physician. They want to get a good physician, but then, you know, they don't ask you, do you want titanium or stainless steel pins in your knee? You know, I mean, that's not a decision they want. So I'm sorry to be emphatic about it, but that's the world I believe that we're looking at.
And I guess there's one quick follow-up is that, can that mandate happen? I mean, again.
Absolutely, it is happening. Okay, this is the world you're going to see. I don't usually make predictions. This is going to happen because of need, and so it's already happening. Wait a minute.
Yeah, thank you.
have-
So let me ask the other side of that question, which is obviously a big challenge in addressing this is overcoming the inertia, both from the employee and, in some cases, the financial advisor. So in a world where you need a customized approach, you know, you talked about the challenge of the averages. You said that you could collect the data, you know, age,
Income.
gender, income, but how do you collect the goals, and how do you do
How do you
it
collect
in a
the goals?
scalable
First
way?
of all, what really happens with goals is, I think I indicated in my comment, I take a smart MIT student, a smart MIT graduate. What did they do? They say to me, what should my goal be for retirement? They don't know. How many people in this room that are under 50 actually know? You know you want a good retirement. Actually know how much income you really want, how much you're going to need for a good retirement. Probably very few, because that's not a problem most of you have addressed. So in reality, that's what people do. They say, you know, if I had to tell you, you don't know. You don't know until a few years before you retire. You don't even know whether you're going to be married, divorced, start a new family. There's many, many uncertainties. I'm going to tell you that a good goal is going to be able to sustain the standard of living that you've come to enjoy in the latter part of your work life. So understand that a lot of this information you compute. The raw data, just if you're wondering, I could get the data. That's for being clever. I can get the data from ADP, you know, I know what you earn from that. I can get it from the employer. I can get, if I don't know if you're an employer, if you're a defaulter, I know what your contribution rate, I can back out your income. And I see when it changes. So there's ways to extract the information without ever talking to the employee, and legal ways. Pardon? No, I mean individual employee, you. I'm not saying the average for the company, I'm saying you, your income. Your income, because you're making contributions into your account. You're making a 5% contribution. I see that number and multiply by 20.
Well, I think it was my turn.
It's just-
But just the follow-on question with the necessary paternalism for the large middle class, where do you see the initiative coming from? More from the large public companies, the private sector, the government, some combination? How is this going to,
I think
how do you see this evolving?
I see it evolving. By the way, it depends on countries, but everywhere, even Australia, I mean, everywhere is this coming because people realize, first of all, I remind you, the DB plans people liked. It was income, and they didn't have to do anything, all right? So it's not like the people that are actually there, this is, okay? It's going the other, it was the other way. So the answer is, I think we are going that way. If you look at what Nest they set up, you know, in UK and everything, everything's moving towards income. Everybody is being asked to come up with a default, okay? The largest and fastest growing area in DC for this plan are so-called target date funds, which are based on age, and that's not good enough. It's huge. Vanguard's a monster in this. Vanguard raised new money of $250 billion last year. New money. Okay? So if you're asking if this is happening, it's crude, but those are defaults. Everybody is working on things where they say to people, buy a 2057 fund, and if you're retiring in 2057, you're done. So the trend empirically today is already clearly that. Now, this doesn't mean financial advisors or planners are out of a job, because most working middle-class people can't afford them. This is designed for parts of the world and for people who couldn't afford to have an advisor, okay? So it's not a competition tool, it's a solution tool. Okay, sure.
Thank you. What's being done in the area of improving financial literacy, not for people to get engaged and make mistakes, but at least to be aware, start early and recognize the kind of things that they need to do? Everything can't be on cruise control. Not everybody may have an employer with a plan like this.
Exactly. Well, part of it is, and this is where we have to get regulators and the governments involved, even if they're not doing it, because this is one of the most regulated industries in the world, and people, you have to be able to tell people things and show people things. So we need to get the regulations require that I show you the NAV. Let me give you an example. I had someone, a 61-year-old, who was all in long-term tips to match up to his annuity. So he was done. Now, he didn't know me, but that's where he was. Interest rates went up. He saw his account go down 15%, and he's 61, and he said, oh my God, I've lost 15% of my retirement income, and went ballistic. Reality was, he didn't lose any income. But that's the kind of message. I'm sorry to be specific in answers, but that's the way you got to get into it. These have to be changed. In terms of educating people, it's not about return frontiers or how to read past history. It's how to understand these principles. I've tried to lay them out for you today. If they understood these principles, like, there's no free lunch and, these things, and not unrealistic expectations, if they realize that the things they can do are this, and that the tools there would allow them to customize their life in an easy way, because the decisions are not about asset allocations or things. They're decisions like, do we want to retire 3 years early to do bird watching? And if we do that, are we willing to lower our goal because we won't be otherwise to do it? It's tough love. Actually, it's good love. It tells them the real trade-offs. Educating them how to use that, yes. How to pick a good physician. How to recognize things that make no sense. Like, there's a free lunch. If it's too good to be true, it's probably not true. Okay? That wouldn't have been too bad for an awful lot of people in the crisis, before the crisis. Okay? So that kind of education, yes. The kind of education where you try to train people on risk-return frontiers and understanding interest rates and all of that, I personally believe that's not going to be very productive any more than I do believe that in medicine. Okay.
Thank you.
Thank you.